Hey, welcome to the Infinite Banking, the Money Multiplier Real Estate Edition presentation. My name's Stephen Nagy, and I will be your host here this evening. So thanks for being here. This is recorded, so if you have to hop off or if you're watching the recording of this and you have questions, anything like that, shout out to me. I'll give you all my contact information here in just a minute, but you can always reach me at nagyleadership.com. So again, my name's Stephen Nagy, N as in Nancy, A-G-Y, and you go to nagyleadership.com. If you guys ever need to schedule a call with me, all my contact information and everything is all right on there also for you. So what we're going to do here this evening is we're going to get into the infinite banking concept, what that is, exactly how you can build a banking system for you and your family and incorporate that into what you're already doing. So if you're a real estate investor on here right now, actually, let me ask, who here on here right now is a real estate investor? Just like RE in the chat box. RE, if you're a real estate investor, maybe you're already doing it, you're getting into it, something like that. Okay, so a lot of real estate investors on here. So that's awesome. So thanks for being on here. LeBaron, I know you invited a lot of people. So if you're part of his group, thank you for being here this evening. Real estate rookie. All right, Roberta, love it. All right, so we're going to get into a little bit about that and what we can do for you as far as that goes. So what I'm going to teach you here this evening is the infinite banking concept. And what that really means is we are going to build a banking system for you and your family. Now, why would you want to be the bank? Why would you want to build a banking system for you and your family where you can be the bank? Let me ask that question. Why? What do you guys think? Put it in the chat box. Why would you want to be the bank? And I'll ask some leading questions. So first off, do banks know how to make money? Absolutely. That's what banks do. Banks are in the business of money. Banks make a lot of money, and they do so through several different ways that I'm going to share with you here tonight. 3 primary ways. But before we get into that, let me start with investing, okay? So why do we invest? Why do you invest in real estate? Why do you do things like private money lending? Why do you invest in the stock market? What's the point of investing? And the point of investing is to grow wealth, right? Plain and simple, to grow wealth. So we know that if we want to make more money, we can either actively go out there and work more, start a business, move up in our careers, or we can take the money that we already have and we can make that money make more money for us. Those are essentially the 2 ways that we're going to grow wealth. So looking at these comments coming in, why you would want to be the bank, most everyone's saying to have control, to pay yourself with interest. Why wouldn't you? Absolutely. Keep your money paying less interest to others. Absolutely. If you can pay the interest to you and not other people, then all that interest you were giving to other people is now in your financial life. So absolutely. I love that. And that's what banks do, right? They lend money out and then you pay them interest. You get the money, you pay them interest. So what if you could be the bank where you lend yourself the money, where you could pay yourself the interest? Right? So that's what we're going to get into. So I love the answers coming in. Jeff said, keep your money, pay less interest to others. And let's see. So we get the spread. The spread we're going to talk a lot about tonight. I love it. Control, control, control. Absolutely. Keep the money in your family. Okay. And then build wealth, leverage. Absolutely. Conventional banks suck. Just get right to the point, Mike, right? Absolutely. So I'll agree with you there. We're going to talk about that. So Robinson said my audio is cutting out. Is anybody else having that issue? If you're having any audio issues, you might want to log out of the Zoom and log right back in. Sometimes that will solve that problem, or just make sure that your connection is good if you have headphones or something like that on. All right. So I love you guys' answers, and you're absolutely right. So let's start with, what is a perfect investment? So put that in the chat box. What is a perfect investment? And I'm going to do a whiteboard here. I'm going to try something new. So go to put in your answers. Liquidity. Love it. So the perfect investment, what's that look like to you? Number 1, liquidity. Okay. Cash flows. Okay. Whoops. 2, cash flows. 3, what else? Tax-free. One that makes you money over and over. So residual income, you're saying. Okay. So Nico said real estate, but why is real estate the perfect investment, Nico? We could talk about that, whether real estate is or isn't. That would be an example possibly, but what else? All right, so Mike said guaranteed growth. Okay. All gain. And so that's kind of along with guaranteed growth, all gain, no loss, right? Okay. What else? Passive income that grows. Okay. What else? Both short-term and long-term growth. Okay. Yeah, tax-free, tax sheltering, love it. Okay. Minimal work. Okay. Minimal work for it. Okay. So like passive security. Okay. That's kind of the guarantee again, right? So a lot of people want that security, that kind of guarantee. And that's preservation of wealth. And in times like right now, with volatility in the markets, with the printing of trillions of dollars, trillions and trillions and trillions of dollars over the last couple of years, with inflation running at 40-year record highs with no ends in sight right now, the stock market is like a yo-yo right now. We have 2 weeks of just booming and then 2 weeks of record dropping, and nobody knows where it's going and everything in between. So a lot of volatility. So I'm seeing a lot with security and stability. So leverage, okay. All right. And somebody mentioned an example of this is real estate, possibly, which real estate, if done within a self-directed IRA, we could do tax-free growth. So if done the right way, real estate could provide that. Real estate could provide leverage, maybe some leverage, and maybe not as liquid real estate. I mean, it does take time to sell and close a house. It could be done quick. It can provide residual passive income. I don't think there's any guarantees to real estate, so that would kind of be put out by real estate. If done right, you could get it down to where it's minimal work. But if you don't talk to anybody that owns rentals, they get tired of the toilets, the tenants, so then maybe we look at real estate doing private money lending and things like that, being the bank. So possibly. All right, and I'm going to talk to you guys about something else. So I'm going to show you the perfect investment right now. Okay. The perfect investment to me is life insurance, specifically whole life insurance. Okay. All right. So I want to talk about that for just a second. Why whole life insurance? All right. So this is the perfect investment. What we need to do is we need to find a way to become the bank to take advantage of everything that we just listed out. What I'm teaching you is nothing new. So this strategy has been used for hundreds of years by the wealthiest families in the world, by people that have money, that people that understand financial literacy, by banks. Okay, so this is nothing new. It's been done for a long time. It just might be new for you. So what I want to do tonight, and my goal with all of this, is for you to wrap your mind around how this works, and then get you to start thinking how you can implement it into what you're already doing. Because here's the best part about this perfect investment, about using whole life insurance built the way that I'm going to show you right now how to build it to use for becoming your own bank, is once this is set up properly, and it's easy to do, it's not going to take you a lot of time. Once it's set up properly, it's done for life. You don't have to do anything else with it. Okay. And so the advantage for this is by setting this up today, you're not going to have to work any harder. You're not going to have to work any longer. You're not going to have to take on any more risk for what you're already doing. But by changing this one thing and implementing this strategy, which is where your money goes first. So your money is simply going to go into your own banking system, which is this whole life insurance policy, as opposed to somebody else's bank, like a Wells Fargo or a Chase or a Bank of America or whoever you do your banking with. And instead of that bank taking advantage of everything and using your money to make more money, you're going to get all the advantages that the bank typically would get in your banking system. And instead of them making all the money, you're going to make all the money. You're not doing anything different. Do you guys like the sound of that? And that's exactly what I'm going to show you here right now, is how to set this up, why you're going to set it up, how to do it right now, so you can take advantage of it literally for the rest of your life without working any harder. You're going to be able to start literally multiplying your money without doing anything different for what you're already doing. Do you guys like the sound of that? And that's exactly what we're going to do right now. So this whole life insurance policy, to make this happen, we have to take a whole life insurance policy and we literally have to hack it up. We have to destroy it. We have to build it almost completely backwards. So we got to murder this thing, and we got to build it for banking purposes, not for life insurance purposes. Now, you're still going to have all of the life insurance benefits, but we're building it for banking, not the traditional way that life insurance is used, okay? Which is for when you die. We're using it for now, while we're alive, starting right now today. There's no waiting on this, okay? So let me talk about how we do this. So, and it's great that it's Halloween season right now, because we're literally going to murder and kill this thing, all right? So let's talk about what that looks like. How do we do this, okay? And just to clarify again, this is what I do at the Money Multiplier. Me and my team, this is what we do. We design these policies for you all day, every day. This is all we do. So I'm a licensed life insurance agent to be able to do this. The Money Multiplier is a licensed brokerage to be able to do this. Chris Noggle is a licensed agent to be able to do this. This is why we are able to do these with you, okay? So we are going to do this all for you, but I'm going to show you behind the scenes right now how we do this for you and how you're going to be able to start taking advantage of it, okay? So first off, why whole life insurance? The perfect investment. Let me go back over to this side. So when I put my money in this whole life insurance policy, I have immediate liquidity. So my money that goes into this thing, into this whole life policy, it's going to start compounding uninterrupted for the rest of my life. Every single dollar that I put into this thing. Simultaneously, immediately, I'm going to be able to pull money out of the policy via what's called a policy loan. And I'll get to that in just a second. But immediately, I'm going to be able to start pulling the money out of it to use it for real estate investing or whatever else that we're doing with it. I'll talk about it in a second. But I have immediate liquidity, okay? So boom, right there. Cash flows. When we take the policy loan from the policy, we can use that money to create cash flow for us, while simultaneously the money's in there compounding and growing for us at the same time. So we can create cash flow, check. Tax-free. All of the money that I put into this whole life insurance policy is going to grow uninterrupted, compounding, tax-free for the rest of my life. So boom, tax-free growth, residual income, okay? So this thing is going to grow and compound on its own. It doesn't require me to do anything else with it. Once I set it up right now with me, once you set it up with me to start with, it's going to compound and grow for the rest of your life without you having to actively do anything else for it. So it's passive and residual, so to say. Guaranteed growth, boom, boom, boom. This policy is guaranteed to grow for the rest of your life. Now, as a former licensed financial advisor, I used to be fully licensed, Series 7, Series 66, variable and annuity insurance, full 9 yards. I was fully licensed as a financial advisor with Ameriprise Financial back in the day, okay? I'm no longer fully licensed, but this was back in the day. When I was a licensed financial advisor, one of the biggest no-nos and one of the biggest things that could get me in trouble was saying that an investment was guaranteed. That's a no-no. I can say that with this whole life insurance policy, the money is guaranteed to grow tax-free, uninterrupted compounding for the rest of your life, guaranteed, okay? So check. All gains, no loss. It's guaranteed to grow. Passive income, again, we talked about that, short and long term. This thing, not only are you going to be able to use it right now to put the money to use, but long term, wait till you see what this thing does for you. Holy crap, it's amazing. So I'll show you that in just a second. Again, once you set it up, there's no longer any work involved. Security and stability, absolutely. Whole life insurance companies, I'll talk about just in a second. They actually are the ones financially that do well in economic downturns because of the way that they invest, which I'll talk about in a second. And yes, we can absolutely leverage this thing and do different things with it. Like LeBaron is saying, a HELOC, you're still paying interest to the bank, it's variable rate. Yeah, we can talk about that. All right. So Stanley said, and again, please put your questions in the Q&A box, Stanley, not in the chat box. I don't want to miss them. But since I'm seeing this, would this work better than a HELOC? No, we can use a HELOC with this, okay? So we can actually leverage the money from a HELOC, dump it in the policy, pull it from the policy and run it over. So remind me in a minute, Stanley, and we'll draw that out of what that looks like, okay? Because I love it, all right? So that's what whole life insurance does. It gives us all of this in the perfect investment. And that's exactly why we use whole life insurance to build these policies and become your own bank. So why? Because it's the perfect investment. All right. So let's talk more about why whole life. Okay. So the IRS, the Internal Revenue Service and the federal government governs whole life insurance policies. They govern whole life insurance policies. And this is important. All right. So follow me here. So this is very important. So when we look at all these perfect investments that the government allows us to do, that the whole life allows us to do, we're allowed to do that because of the federal government. The IRS allows us to do this stuff. Why do they do that? It's because the rich, the powerful also are putting all of their money into policies like these. So check this out. So there's been a lot. So people like Jim Harbaugh used whole life insurance to become the top paid coach of college football. A lot of his compensation is paid through whole life insurance. And this was an article from November 16th, 2016. You guys can go Google this and read more about it. So Joe Biden, the president of the United States, uses whole life insurance. Look at this. He holds 6 life insurance policies with Mass Mutual. It's one of the companies we've done business with. Biden reported, and so he puts a lot of his money. Why? Because it's protected. Oh, we didn't even mention that. On the perfect investment, don't you want that money to be protected from lawsuits, protected from bankruptcies, protected from people suing you? Well, life insurance is a protected asset in almost all states where they can't come after your money. So it's protected in there. So that's why the rich, the famous politicians love these things, because it's private. It doesn't have to be reported anywhere. So it's private and protected money. So Walt Disney used whole life insurance to start Disney World, just as an example. And the list keeps going on and on. Keep it going. The Pampered Chef, Doris Christopher, used life insurance. $3,000 she borrowed from her life insurance to start the Pampered Chef in 1980. The company sold for $1.5 billion to Warren Buffett. She leveraged her whole life policy to start the Pampered Chef. So again, I want you guys to start thinking about how can you do this in your businesses. Ray Kroc with McDonald's. And then in some of the wealthiest families, the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers, they've been using this, politicians have been using this for hundreds of years to grow and build wealth for them and their families and create legacies. So this is all stuff that's been being used for a long time. So if they're using it, again, why wouldn't we use it? Okay. Again, banks. Remember I mentioned banks before. This is some homework I'm going to give you guys. Go look up something called BOLI, bank-owned life insurance. So bank-owned life insurance, BOLI, and that's what we're going to dig into right now. Why do banks use whole life insurance? Banks are the largest purchasers of whole life insurance in the entire country. Banks. That's why when you go into a bank, everyone is a vice president in there because it gives the bank an insurable interest and they can buy a life insurance policy on that individual. Again, do banks know how to make money? Absolutely. So we're going to talk about the banks. So whole life. So why whole life? Because we can. Because the rules and the regulations that are set by the IRS and the government allow us to do all of this. That's the plan. There's no other vehicle where we can put our money into that gives us all of these advantages. And what are those advantages? One more time: uninterrupted, compounding, guaranteed, tax-free, protected growth of our money for the rest of our lives. That's what whole life insurance allows us to do. Again, this is not a standard whole life policy. This is one that we butcher, that we murder, that we completely change for banking purposes that I'll show you in just a second. Number 2, why else do we use whole life insurance? Because of money movement. These are what I call the 2 laws of wealth. To build, maintain, preserve wealth, you have to always be doing these 2 things. You have to take advantage of uninterrupted compounding interest. Albert Einstein is one who told us compounding interest is the 8th wonder of the world. Those who understand it use it. Those who don't, pay it. Would you rather understand this and use it for the rest of your life, or be paying it to other people like banks for the rest of your life? Number 2, what I understand about growing and preserving and maintaining wealth is our dollars. We always have to keep our dollars moving and making more money for us. So right now, if I take my money and I put it in a savings account, it's doing nothing for me. If I take the money out of the savings account and invest it, it's now gone. It's in the investment, which is fine. But here's the alternative. If I can put my money into this whole life insurance policy, it's basically like a savings account on steroids. Because my money, every dollar that I put in again, takes advantage of this perfect investment. while simultaneously I can take the money out and keep the money moving in things like real estate, making more money. So I'm able to accomplish both of these things at the same time. 2, 4, 1 with this whole life policy. All right. So it allows me to do both the things, money, making more money. So that's things like private lending, things like real estate investing, things like short and long-term rentals, things like funds, things like even the stock market. I mean, even traditional investments like that. But, businesses, we can invest in businesses, grow wealth. We can start businesses and get them going and creating more wealth. So that's all money movement, and that's all investing. So it starts with one, putting the money through the policy first. Again, just changing the one thing where our money goes first, and then keeping that money moving. So that's what we're going to focus on here tonight. So this is why life insurance. All right. So to take this a step further, company. Okay. So this is what we do behind the scenes. How? So this might be the how life insurance. Okay. So how do we butcher these policies and design these for banking purposes like I've been talking about? So first off, it starts with the company. So we have to look for a company. Okay. So we have to, so what we do is we look for companies. So first off, it has to be a mutually owned insurance company. All right. That's what allows us to not only mutually owned, but dividend paying. And then the insurance company has to have a long track record of successful dividend payments. To get this uninterrupted compounding tax-free growth, the money that you're putting in the policy is going to compound tax-free through company dividends. Okay, so these annual dividends that the insurance company pays out to its policyholders are what create the growth within the policy itself. Okay, does that make sense to everybody? And so we want to find a company that has a long track record. So all the companies that we build these policies with have well over 120 years of successfully paying dividends to the policyholders. Because what does mutually owned insurance company mean? Well, a mutually owned insurance company means when you buy a policy and you have a policy, you start a policy with that company, you're now an owner of that company. The policy holders are the owners of that company. That's what mutually owned means. So the owners of that company, the policy holders, share in the profits. And that's what the dividends are. Those profits, those annual profits of the company are paid out through dividends to the policy holders. And that's what gives you that growth of the policy. So we want to look for companies that have long track records of paying successful, strong dividends out. Financially very strong companies. So, things like A+ ratings. So some of the companies that we use, AUL, which is American United Life or One America. We use Lafayette. And again, you guys can look this stuff up. You can research this stuff. Lafayette Life Insurance Company. These are just some of our favorite companies that we use right now. Owned by Western and Southern. Okay, we use, sometimes we'll use Guardian, we use Penn Mutual, we use a company called Securities Mutual Life, just to name a few. But I would say 80 to 90% of our business is probably done with One America and Lafayette Life Insurance Company. Again, Money Multiply has been doing this for over a decade now. We do tens of thousands of clients. We have tens of thousands of clients. So we have a lot of experience. Which companies are easy to work with? Which companies support infinite banking? Which companies have these strong dividends? So this is all stuff behind the scenes that we're doing, but I just wanted to give you a look behind the scenes. What does this look like? Why are we losing the whole way? Okay. So it starts with the company. All right. So when we use the company, now how do we build a banking policy, right? So this is where we do things backwards. So we build it backwards. All right. So a typical life insurance policy, what do I mean by that? A typical life insurance policy, you're going to say, okay, well, how much death benefit do you need? Okay, you need $2 million in death benefit for this amount of time. And this is what that looks like. And this is what it's going to cost you. All right. We don't do that. We don't really care what the death benefit is. The death benefit will be there. It'll be nice when it happens. It's paid out tax-free to your beneficiaries, but we're doing this now. We want to start using this thing today for banking purposes. All right. So we're going to start with, how much do you want to fund the policy with? So how do we fund a policy? All right. So number one, annual premiums. So these annual premiums are the amount that are going into the policy each year. That's the you're going to determine upfront how much you're going to put into the policy on an annual basis. Now, your options for paying into it are monthly, quarterly, and I'm typing fast, so if I do typos, just ignore them. Biannual or annually, okay? So those are the options for putting money into this thing, but you're going to determine basically on an annual basis what that looks like. So if it's $12,000 a year, obviously that's $1,000 a month, $3,000 a quarter, whatever that is. Guideline minimum, what we would recommend, 10x your age monthly. So if you're 39 years old, like I am, $390 a month. If you're 50 years old, $500 a month. If you're 25 years old, $250 a month. If you're 60 years old, $600 a month. So that amount or more on a monthly basis would be like a guideline minimum. If you can do more, great. Again, the more money we can get into here, the more compounding you're going to have, the more growth and all that good stuff. But as a guideline minimum. Now, number two, dump it. So when we open one of these policies for real estate investors, this is going to be super important because as a real estate investor, a lot of times you have big chunks of money, okay? So when we're looking at how much do we want to fund this policy with? So when we're funding the policy, we determine how much we're going to put into it annually. But let's say that you're comfortable, putting in $12,000 a year. You say, okay, I'm good putting in $12,000 a year. That's what I want to do moving forward. But I got $50,000 sitting in the bank right now, or $100,000 sitting in a savings account, not doing anything. I just did a real estate deal. I made a nice chunk of change. It's just sitting there. I'm going to need the money for my next flip or for my next investment. But while it's sitting there, I want it to do something for me. Okay. But I'm not comfortable yet. This is still new for me. So I don't want to dump it. I don't want to commit to $100,000 every year putting into the policy. I'm good with $12,000 a year, but can I put more in the first year right now up front? The answer is yes. So during the first year, we could do what we call a one-time dump in, and we can put in a larger amount on top of what we're going to put in annually into the policy. Okay. So this is called a dump in. So we can do that any amount of money, basically up to about 10x. So let's just say in this example, 10,000 dump in, and then $1,000 a month going into the policy. Okay. So the way that would look is 112,000 going in the first year, and then $12,000 a year after that. What does that look like as far as pulling the money back out to use for real estate investing? All right, so here's an actual policy I did for, this was a real estate investor out in, I think, Oregon or Washington State. She was a female, 41 years old. So you can see here, this is what we call a life insurance illustration. So when we start a policy for you, and there's an approval process involved, and I'll talk about that in a second. But when we determine how much you're going to fund this policy with, again, you're going to determine how much goes in, the first year, how much annually, and then we're going to design the policy and we're going to build it for your goals. So for a real estate investor, I'm going to build it very high cash. If you're looking for longer term growth, maybe we build it for a little less cash immediately, but a little stronger growth on the back end. But we could talk about that on the initial call, which I'm going to do with every single one of you that wants to talk. We're going to set up a call, okay? To talk about things like, what are your goals? What do you want to do with this policy? How much should you put into it? What is your situation financially now? So I'm going to talk to you about, with your situation, I'm going to talk to you one-on-one about that. So don't worry about that, but let me show you what this looks like. So this is what's called an insurance illustration. This is a whole life illustration. So this shows you what the policy is going to do over time. Okay. And I can pull up 100 of these illustrations. I just happen to have this one saved on this PowerPoint. All right. So 41-year-old, the year of the policy, how much they're putting into it. So she wanted to do $50,000 a year. You can see right there. But she had an extra $100,000 sitting there the first year. So you can see right here, the first year, we got $150,000 into this policy. All right. And then what we're going to do is we're going to jump over here. So these are the parts that we're going to look at. So first off, the death benefit. We aren't doing this for death benefit, but if you were to pass away and graduate onto the next phase of whatever that looks like that you believe in, it would be nice to know that you do have some money that's going to your loved ones, your beneficiaries, the people important to you in life, right? Maybe you have a trust set up where you can control what happens with that death benefit from the test, from the trust, from the grave, essentially. So this is how we start building family legacies and banking systems and keeping the money within the family. So while we don't do this for that reason, when you start looking at family banking and legacy, this is an important aspect, and we can talk more about that later also. All right, so the cash value, though, is the amount of money that we're going to be able to use now for banking purposes. And then this column is going to show us how that money increases each year as we put our premiums, known as the deposits, into this thing. All right, so one important aspect is the money that's going into this policy is the premium. That's what makes up the whole life insurance policy. But for mindset purposes, I don't want you to look at this as a premium. I want you to look at this as a deposit. Why? Because it's mental, especially when you're starting new. A lot of this is a new way of looking at money and how money flows. So if I just made $150,000 on a real estate deal, I'm excited. And I'm going to go down to my bank and I'm going to deposit that money, or I'm going to pull out my app on my phone and I'm super excited to scan that check in there and get it into my bank account because I just made $150. So I'm super excited to deposit that into my bank account, right? So if I'm going to do the same thing, but I'm going to deposit it into my own bank, which happens to be a whole life insurance policy, I want to start thinking to myself, I'm depositing money into my bank account. I'm not forced to pay a premium, because a premium a lot of time is associated with things like a car premium or another type of insurance premium or something like that, right? It's a negative. But at the end of the day, this is a positive because it's growing your banking system, which you're going to see right here. Okay, it's growing it. So I want to start looking at this as a positive. Right, so that's why I want you to start agreeing to look at these as deposits, not premiums. Fair enough for everybody? All right, so let's get into this. All right, so when she puts $150,000 in the first year, you can see the cash value available. So again, this is the amount that's available for loans. So let me explain what a loan means. All right, so when we put money into this policy, this is the amount available to use. Right here in the cash value, right? So that's how much we have to use. But when we use that money, we're not withdrawing it from the policy. We're actually letting it stay in the policy. And what the insurance company is doing is they're giving us a loan and using our money within the policy as collateral for that loan. And they're actually lending us money from the insurance company's general account. But that's what allows the money to stay within the policy, compounding and growing for you, uninterrupted, tax-free every year for the rest of your life. So when we take the money out, it does come out in the form of a loan, and that's why. When you take the money out of the policy, you are paying 4.5% to 5% for that loan. But remember what I told you before about those dividends. The money within the policy is growing at about right now 5.5%. So you have compounding growth within the policy of around 5.5%, while you're paying simple annual interest of about 5%. So again, somebody mentioned it before, but we're already making a little spread. Okay. So we're making a little spread here. But not only that, you can see as time goes on, which I'll show you in just a second, when you start talking about over here, you're talking about simple interest we're paying on loans versus compounding interest we're getting on the policy dividends, it's not even close. And I'll show you that in just a second. So every year you have this thing, the spread that you're making on your money is going to be more and more and more and more. And then on top of whatever you're using that money for. So if you're investing with it, you're making even more spread. If you're recapturing money, that interest you were giving to other people before, now you're making more spread through that recaptured money. But we'll get into that. All right. So look over here. So we put $150,000 in the first year. The first year they have $132,000 available to pull out. Now, when is that available to you? It's available to you immediately. And when I say immediately, I mean within 30 days. What this is going to look like is when those of you that want to start one of these policies, you're going to schedule a call with me. Okay. On that call, we're going to talk. I'm going to answer any questions that you have, and I'm going to clarify anything that needs clarified for you. And we're going to determine how much you think you're going to fund that policy with. Okay, so we can get the process started. From there, you're going to go over to my application team. My application team is going to start the approval process for you. So because this is whole life insurance, there is full medical underwriting. So there's an insurance application. We're going to look at the insurance company is more than likely going to require an exam be done. So they actually send a nurse out to your house and take your blood and have you pee in a cup and all that good stuff. They take your blood pressure. They're looking at you saying, do we want to give you a life insurance policy, or do we think you're going to like die sometime soon where we don't want to give you one, right? Just to put it bluntly. So that's what they do, is they underwrite these things. So that process takes about 6 weeks. During that approval process, we're going to design your illustration just like you see on the screen, but for your numbers and your situation. And then you're going to get that right away. So you're going to see what this looks like for you immediately. And then we can make adjustments. We can make changes to it. We can tweak it, whatever we got to do during that approval process. And then once you're approved, we look at it one last time and we say, okay, this looks good. Let's go ahead and sign it. Let's put our money in for the first time. And as soon as you do that, you're in force and you're banking. Within a couple of days, you go over to what's called our mapping team. So this is all free, guys. We don't charge for any of this. The consultation, the application team that's going to help you get approved, anything that I do with you to help you with tweaking the policy, making you understand and answer your questions. There's no charge for any of this. And even once you have the policy, our mapping team is going to meet with you every 3 to 4 months to update things, to see how things are going. How are you using the policy? They're going to create a map for you, which we're not going to have time to get into tonight, what like a debt map looks like, or, if you purchase a car, for example, how to recapture every single dollar for that car. But we map that out for you and show you exactly how to do it. And it's free of charge for life. So you're never going to pay the money multiplier a dime. Now, the reason that we're able to do that is I make my money through commission from this policy, okay? Which I'm going to talk about in just a second when we go back to the whiteboard. But we do take a heavily reduced commission to give you access to all this money. But let me get back to the illustration over here, okay? So we're immediately making that spread. So we put 150,000 in the first year. You have access to 132,000 to pull back out to use for your next real estate deal, for a major purchase, for money for a deal that you're doing, whatever you need the money for, it's available for you immediately within 30 days, okay? Check this out. Second year, you put 50,000 in. The second year, when you put $50,000 in, the policy is going to grow by $48,000. So you still don't have access to all of the money that you put in, but we're getting there, okay? Again, you got to look at this. This takes time to build, but once it does, it never stops. And that's where it gets exciting, okay? So check this out. The third year, put $50,000 in. Now we have access to a little over $50,000. So this is what we call the efficiency point. And once you get to the efficiency point of your policy, it never stops for the rest of your life. And you'll see each year it just gets stronger and stronger and stronger. So the fourth year, 50 goes in. Now you have access to 53,000. So now we're starting to leverage the policy because we're borrowing back out and we're using more money than we've ever put into the thing. So we'll just scroll down here. The seventh year, 50,000 goes in, pull 63.5 back out. But look down here in the 11th year of this policy, and this will happen for you too. The amount that you're putting into it after the 10th year is going to drop. Okay. But watch what happens when this drops. So now the 11th year of this thing, $17,000 goes into it, but look at the growth over here, $45,000. So I put $17,000 into this thing and I can immediately pull back out $45,000. In the 15th year, when I'm 55 years old, $17,005 goes in, I can immediately pull back out $54,000. And if I showed you the rest of this illustration, it just becomes dumb. Like the amount of growth that only 55 years old. So I asked you at the start of this. All right. And you can see, again, I'll just show you, keep going on and on and on and on. And you'll see the death benefit just grows more and more and more every year for the rest of your life. So when I started this out, I said, how many of you would want to be your own bank? Why would you want to be your own bank? And you guys had some awesome answers. For me, why I want to be my own bank is so I can have my own ATM machine. All right. Let me pull you up one other. Actually, this is a policy I just did for somebody. I literally just got the illustration a few minutes ago. Yeah, their name's not on it. Okay, I'm going to share this. This is one more illustration I just did. But why would I want to start my own bank? To create ATM machines. And what I mean by that is I look at this whole life policy as an ATM machine. Why do I look at it that way? Let me show you exactly why I look at it that way and why you should start looking at it that way too. So check this thing out. In the first year of this thing, they're going to put $112,000 into it. Okay, you see that right there? So we're going to put $112,000 in the first year. They have access to, again, same illustration, 105,000 of that. So not all of it, but pretty close. But look what happens. The second, I built this for the highest cash value possible for this investor. $12,000 goes in the second year. They can pull back out over 14,000. Fifth year, 12,000 goes in. They're going to pull back out over $17,000. I mean, look at these numbers, guys. Look at this thing when it drops. At 50 years old, they put $6,000 into it. They can pull $21,000 back out. The reason I look at this as an ATM machine is because if I know each year that I own an ATM machine and I could put $12,000 into it and immediately the next day pull $17,000 back out. The next year I could put $12,000 into it and immediately pull $18,000 back out. Put $12,000 in, pull $20,000 back out. What? I mean, would you want an ATM machine like that? And if you would want an ATM machine like that, like I would, how many of these ATM machines would you want? Because what happens is if this is my ATM machine right here, this is what I'm limited to putting into it. I can only put 12,000 a year in. So whenever I'm ready to put more money in to grow my banking system, it's when I start opening additional policies. So I start opening additional policies, creating basically branch offices that give me additional ATM machines. So now my first policy, that's ATM 1, I'm putting money in and pulling money out of that one. ATM 2, I'm putting money in and pulling money out of that one. ATM 3, putting money in and pulling money out of that one. And I'm just building my banking system and growing more and more ATMs as I personally grow financially. All right, so those are just some different examples of what those policy illustrations look like and what the funding looks like. Now, if you have no dump in, I think I saw somebody in the comments ask that, no problem. Starting small. So my recommendation actually to people on the phone, start small, start conservative. If this is new for you, start with the minimum. Start with small monthly payments, deposits, not payments, again, deposits, I'm saying it, deposits into this thing and prove the concept to yourself. If you don't want to see the hundreds of case studies that we have and thousands of clients and everything else, I've literally done over 1,000 of these policies now, and I've never had one person complain or give me negative feedback in over 3 years now, or almost 3 years now. So it's a beautiful thing, but prove it to yourself. Start small and start adding policies. Start growing your banking system by adding more and more policies. So that's no problem whatsoever. All right. So that's why we look at, how the insurance company, and like I said before, when we build these, so we hack these things, hack these policies up. So the way that we do that, again, we build it backwards, like I just showed you. So build backwards, build for cash value, not death benefit, high cash for investors immediately. So this is all stuff that we do this. So how do we do it? We give up 60 to 90% of commissions. So even though we get paid directly from the insurance company commission on these policies, that's why we don't charge you anything. It's why I have to be a licensed insurance agent to do this. We make a very reduced commission to be able to do policies this way. Why? You benefits, not the agent. And how many financial advisors, how many insurance agents, if you told them right now, hey, you can do a whole life policy for your clients that's more beneficial for them, but you're going to make 80 to 90% less money. Are you willing to do it? Most advisors and agents are not willing to do that. It's not their business model. It's not what they do. And this is all I do, 100%. If you want some kind of IUL or term or some other kind of insurance with high commissions and all that stuff, I'm not the guy. This is all I do. This is all Money Multiplier does, 100%. So plain and simple, that's how we do this. That's why we're able to do this stuff. Now, I know there's a lot of questions coming in, and I definitely want to hit those questions. Yeah, so LeBaron eligibility requirements. Like I mentioned, there is full medical underwriting. And here's the thing is if you don't qualify for some reason, you can still start a policy. So you can own a policy on somebody else's life. So somebody like a business partner, a spouse, a child, somebody that you might have insurable interest on, So we can talk more about that in your situation, but absolutely, we do that every single day where, somebody just doesn't qualify health-wise or whatever the reason is, and they just own a policy on somebody else's life. So that way they're putting the money in, they're borrowing the money out, they get full benefits of the policy today. It's just on somebody else's life. That's it. Yeah. So there's not really a maximum to put into the policy. There's actually minimum and maximums. Again, 10 times your age on a monthly basis as a guideline minimum. But a maximum, we don't really have one. It's whatever you build it for. Now, I will say, if you say, okay, I'm going to put $10,000 a year into this first policy, that $10,000 a year is the most you'll be able to put into that policy. So when we build these, I mentioned the IRS earlier, there are rules and regulations that we have to work within when we design these policies, and they're called the MEC rules. Stands for Modified Endowment Contract. And so one of the rules when it comes to MEC is you can't put more money into it than what it's built for. So that's the reason why instead of putting more money into an existing policy, you have to start opening additional policies to build your banking system to get more money in. So within 30 days, you can start borrowing the money back out. So Nicholas said, how do I use a HELOC in a state that does not allow first position HELOCs? Okay, let's talk about a HELOC for a minute. So it doesn't really matter the type of HELOC. I mean, all a HELOC is a line of credit, right? So let's say this is the HELOC. I don't know, what's a good amount of money for a HELOC? Let's say 100 grand. And then what's an interest rate on a HELOC right now? Let's just say 5%. Is that okay for argument's sake? Let me see what you guys are saying. Fair enough, about 5%. Yeah, they are going up. I know, Todd. 6 point. All right. 7%. All right. And as HELOCs go up, it is becoming a little more difficult to do this strategy and to really make this make sense. But I'll show you what it looks like nonetheless. Okay. So what you would do is you would take the HELOC. Let's just say it's $100,000, and you would dump that into the policy. Okay. So now we have the policy. Dump that in the policy. And then, what you'll do from there is you borrow the money from the policy. Let's say it's a real estate private loan. Just keep it simple here. So again, when you put the $100,000 into the IPC, let's just say you have $95,000 available. Again, remember the first year, you're going to have a little bit less. So you're going to have money that's going back to the HELOC. All right. So we'll talk about this. So let's say it's a real estate private money loan. So the IBC, you're going to pay 5% for the money there. So if I take the 7% I'm paying for the HELOC and the 5% of the policy loan, I'm all the way up to 12%, 12% total. So on a real estate private money loan, what I'm looking to do is make a spread. So if I do a private money loan at 12%, there's not really a spread there, right? So I'm paying 12% for all this money. I get a 5% loan from the policy, 7% loan from the HELOC. That spread right there, I'm not really making much of a spread. So let's say it's a 15% private money loan, and I know some deals right now that are getting like 18, so there's definitely opportunities there. If it's your own deal, probably higher. But even right there, it's a 3% spread. So at least you're making something. But on top of that, not only are you, and then again, as you're making that spread, then the money's going to go back to the policy. The money's going to go back to the HELOC, and then you keep, that you're going to keep that profit. All right. But the one thing that will do for you is it gets the money in the policy. So what you're doing here is you're leveraging money from an existing property, and you're leveraging somebody else's work. And remember, now that the $100,000 in the policy, what's it doing? It's growing, uninterrupted compounding for the rest of your life. So within the first few years, you might not see a big advantage to this. You're not really making much of a profit. You're barely covering your expenses and the loans. But over time, you're using somebody else's money, essentially. You're leveraging somebody else's money to grow your banking system. So now the money's in that policy, and as you repay it, with this private money loan and repay the HELOC, that money will be there for life. So over time, you will eventually build that up within there using somebody else's money. You're just not seeing a big advantage of it right now. So that's what that would look like with the HELOC. Now, let me mention one other thing real fast. The policy loan from the policy, those don't have to be repaid. Okay. You're in complete control of this. You're the banker. Remember that. So even if you use it to purchase a car or whatever the case is, you're in complete control of this. So how and when or if you repay those loans are completely up to you. The insurance company doesn't care. So now when you take and use the money from the policy, if you're using it in a real estate deal, you don't have to worry about paying that policy back at any time. You can just do it all at the end of the deal or never at all if you're going to continue using that money. So the loans from the policy never have to be repaid back if you don't want them to be. If you're using the money to make more money, then don't repay them, okay? But this is all stuff we can talk about on the call. We can strategize. The mapping team is really going to help a lot with that also. But just know you don't have to repay these loans. The only thing the insurance company wants is the loan interest. So once a year, we're going to recommend you pay whatever that loan interest is annually out of pocket to keep up with it. Again, simple interest, but that's kind of part of the strategy, okay? LeBaron said, can you explain the time frame for repaying the loans as you capture money deposited? Yeah, so again, you don't have to, that's what I was saying that, LeBaron. So you don't have to pay back those loans ever. It's up to you. You're in complete control. Roberto was just asking about Mass Mutual. So Mass Mutual told us they don't support infinite banking and they don't want people taking policy loans. Even though they allow them, they don't want people doing it. And so we just basically said, you know what, if you don't want to work with us, then we don't want to work with you. And if you don't support infinite banking, then we'll take our business to somebody that does appreciate infinite banking. And all the other insurance companies love us and love what we do with infinite banking. They love our clients. They're great to work with. Their servicing is amazing. So we get the support that we need with them. So that's all. All right. Dave said, in this example, when will the cash value be equal or greater than the total premiums paid into it? So that's a good question, Dave. So Dave is just asking the cumulative. So let me talk about that for just a second. Let me pull back up the example. So here's the money going into the policy. Here's the cumulative money going into the policy. All right. So you'll see in the third year, we put 30,000 in, we pull over 30,000 out. And then each year it gets stronger and stronger and stronger for the rest of life. This is what we call positive cash on cash returns. And you can do the math on this stuff. I mean, down here, I put 17,000 in, it grows by 45,000. I mean, this is like a 200 and some % cash on cash return. So that's what we look at annually. That's what we call an annual cash on cash return. The cumulative return we could see right here. So this is the total cash value in the policy. So you can see right here, cumulative in the 6th year of this policy, we put $400,000 in, and now we have over 400,000 available. The next year, again, it's just going to get stronger and stronger every year. So you can see cumulatively. So in this case, Dave, the 5th to 6th year is when cumulatively the policy is now greater than, and then that'll just continue to grow every year for the rest of your life. And then in those first 5 years, you're a little behind, but at the same point, remember, we're using all of those dollars, all of that money every single year to grow our wealth. So how much can you make with that money to overcome kind of being behind for the first few years? And then again, so if we're looking at this long term, once we get to that efficiency point, it's a no-brainer. But how can we really, make smart investments now to not be behind in the early years? So Seth is saying, can we explain recycling money back into the policy? Yeah, definitely. So this is what it looks like on how we're going to borrow money out and then bring it back in. So this is the policy. This is the money multiplier life insurance policy. So let's just say we take a loan from the policy, okay? What we're going to do is we're going to teach you how to set up what's called a segregated bank account. Now, the segregated bank account is just a separate checking account, and it's going to allow us to keep track, and it's going to account for money. And this is nothing special, just a free checking account that you can run money through. Money's not going to sit in there for longer than a month or two, okay? So we take a loan from the policy. From there, we're going to use the money, okay? If you're doing private money lending, I'm just going to use the Private Money Club as an example because that's what I use. If you're not familiar with the Private Money Club, join us tomorrow. And again, tomorrow on the Wealth Webinar at 1 p.m. Eastern, we're going to get in deep about all this stuff, okay? So if you really want to see what this looks like, please join Chris and I tomorrow at 1 o'clock Eastern. And as soon as I close this or stop sharing my screen on this for Seth's question, I'll put the links in so you guys can get all this stuff, okay? So this is the Private Money Club, just as an example. So we borrow the money from the policy. We take that money and we do a private money loan. And now now with the private money loan, we have monthly interest coming in. So as that monthly interest comes in, it's going to go into my segregated account. Now from there, I'm going to keep the spread again. So I know that I'm going to be paying 4 to 5% on this insurance loan. And let's just say that this private loan deal over here is 12%. So I'm making a 7% spread. Now, while I don't have to pay back that money, that recaptured money back into my policy, I want to, okay? Because I want to get it back into there so I can do this over and over and over and over again. And again, if I'm not using the money right now for anything for future investments, why pay interest on it? So I might as well get it back into the policy, because this 4 to 5% is annual interest. So if I'm repaying that loan throughout the year, the actual interest I pay is going to be a lot less, maybe 1%, 2%, 3%, depending on how long it was out, but it's going to be actually a lot less. So our spread is actually going to be a lot higher when we look at it that way. But nonetheless, that's what that looks like, Dave. We capture the money back into the segregated account. From there, we either get it back into the policy to use it over and over again, or if we're taking any profits, the profits will go into our life to use for whatever we're using it for. Okay, so that's plain and simple right there. There's no cap on how many policies you can open in the same year. Devin Burr, Mr. Burr, started with us less than 2 years ago and has 9 policies now. It's just so no limit. Can you please explain what happens upon death? Yeah, when you pass, all of that death benefit minus any outstanding loans. So I said before, the insurance company doesn't care if you repay the loans. You don't ever have to repay the loans, because all they're going to do is they're going to take that money out of the death benefit before they pay that death benefit to your beneficiaries. So if you have a $2 million death benefit and you pass away and you have $300,000 in outstanding loans at the time, they're just going to reduce the $300,000 of outstanding loans from the $2 million death benefit, and then they're going to pay out the balance of $1.7 million. And that death benefit get paid out to whoever your beneficiaries are, completely tax-free. It avoids probate and estate taxes and all that stuff. That's one of the huge advantages of it. Our advantage to give up commissions is because this is all that I do 100%. So all I do is infinite banking concept. So I go into this knowing that I'm giving up the majority of my commissions to do it this way, but we do volume. Again, I've done over 1,000 policies in a couple of years, which is a lot compared to a typical life insurance agent. So we deal in volume, plain and simple. And then, of course, we not only do this, but we do everything else that we do with financial education, Chris and I, with Money School and the Private Money Club and Nagy Leadership and everything that we do. So James said, I'm using money from a HELOC for Private Money Club lending. Should I also pull money from my IBC to lend? Oh, absolutely, James. If you have money sitting in a whole life policy right now, let's get that money out and get that money moving. Absolutely. Is there a cap on policies? No. How long does the process typically take? To get approved? Usually about 6 weeks. If it's a second policy within a year, we can usually do it a lot faster. Steve asked Hannah before, they said they don't cover Guardian. Yeah, we do have Guardian now. So if you want to talk about Guardian or anything, just let me know. But we are appointed with and partner with Guardian now also. Ryan said he got a policy with Mass 2 years ago. I remember you, Ryan. Absolutely. You're my client. Can I continue utilizing infinite banking? Yes. Yeah. So if you have an existing Mass policy, I mean, I do too. Nothing changes. It's just we're not doing new Mass policies right now at the moment. So yeah, if you have an existing, no problem. It's all good. And I love it. I love my Mass policy. So if you have a policy on someone else and you graduate, who is in charge of the policy? Nobody, John. So if you own the policy on somebody else's life, when they die, the policy is over. So it's a life contract. And when that person whose life it's on dies, the contract ends. So the policy death benefit is paid out to the beneficiaries, and that's it. So here's some resources I would recommend. So write this stuff down. Number one, these are some good books. So Second Chance by Robert Kiyosaki talks all about the infinite banking concept. Money Master the Game is just a great financial education book. And he talks about it in Infinite Banking, I think in chapter 6 or 7. Please correct me if I'm wrong. Yeah, if you're over 50, if you're over 60, even if you're pushing into your 70s, Robert, it makes sense to do an IBC policy. Absolutely. This is my favorite. This is like the #1 book right here, Becoming Your Own Banker by R. Nelson Nash. I would start with that. So go buy that book if you can, or listen to the audio on it. It's on Audible. Mapping Out the Millionaire Mystery and the Private Money Glide. So a lot of real estate investors on here right now. These are the 2 books I would start with if you're real estate investors. And I'm going to give you guys these books for free, actually. All right. So what you're going to want to do is go to this website right here. So first off, there's all my contact information. So I'm going to put this in here. Okay. So if you want a free copy of those books right now, I'll send you a digital copy of them instantaneously. Go to that website right there and put in your information. A, you'll be able to schedule a call with me. And B, you're going to get additional resources and those 2 books digitally for free. So that's one way to do it. Number 2, and obviously all my contact information is on there as well. So if you need anything, you guys can reach out to me. Or this is actually a lot easier if you do it this way. Or if you would like to, watch like the full actual presentation that gets into how to pay off debts 3 times faster while continuing to build wealth. We have a case study on that training on how we took a chiropractor that was $450,000 in debt. We paid off all of his third-party debt in 6 years while he continued to build wealth using this system. We also show you how to start doing things like buying cars and recapturing every single dollar for that car. In fact, Devin Burr, just to give you an example, I mentioned him before, so I'll use him now. He just bought a new R8. It's like $250,000 car. He will, over the next 6 years, by using his policy to purchase that car, he will actually make money. He will actually personally make money purchasing that car and driving it for the next 5 to 6 years because he used his policy to do it. So in that example, on that, in that training, we'll show you how to do that also. So those are the 2 places you want to go. And again, NagyLeadership.com. Right at the top of that, you're going to see that additional training that you can watch that gets into those case studies and how all that works. Tonight, I wanted to do things a little bit different and kind of talk more about the investment side and what that looks like for you. But those would be the 2 resources, and both of them have the ability to schedule a call with me. If you would like to talk and you can't find availability in the schedule, let me know and I'll schedule something outside of that with you. So my email is snaggy@themoneymultiplier.com. And that contact information should be on that site as well. But those would be the 2 places where you should go right now if you'd like to get copies of those books, and more importantly, get a call scheduled with me so we can talk about your personal situation and what that looks like. All right, guys. Well, I hope everybody learned something tonight and this was beneficial. I appreciate you taking your time to be here with me. Like I said, make sure you join us tomorrow for the Wealth Webinar Wednesday series at 1:00 Eastern. Chris and I are just going to continue what I've been talking about here tonight and really show you how you can start using these policies for real estate investing, even if you're new to real estate, or even if you're looking at being more of a passive real estate investor, doing things like private money lending, or if you need money for your real estate deals using like the Private Money Club. Join us tomorrow so we can get into more of that and what that looks like tomorrow. And how to join us tomorrow for the Wealth Webinar series. You can go to, again, if you go to NagyLeadership.com and scroll down, you'll see links to register for all of our weekly webinars and how to watch them. So you can register for the Wealth Webinar series. We also do What the F on Wednesdays, Ask Me Anything on Wednesdays. Monday, I do Money Club Mondays. So if you go to NagyLeadership.com, every single one of those webinars and Zooms that we do, you can register for them directly at NagyLeadership.com. So Todd, thank you, sir. Appreciate you being here, man. You're always here, supporting us, answering questions in the chat box. So Todd, we really appreciate you as well, my friend. LeBaron, thank you. Appreciate you inviting your inner circle. If I can help you at all, LeBaron, please let me know. And if you guys are part of LeBaron's group, just let me know you're part of his group. And I don't know, we'll see if we can do something special for you guys for being here tonight. All right. So I look forward to talking with every single one of you. Thank you for being here. Have a great night. We will talk soon. All right, guys. Cheers.